Hello everyone, this is Ted Bauman here, editor of the Bauman Daily, with your last Bauman Daily video for the year. Normally at the end of a year, people like me will try to recap what's happened to the year, try to reflect on major developments and so on. What I'm going to do is talk about 7 lessons that I've learned, not just in terms of markets and the economy, but also just in terms of the process of communicating via YouTube about these issues. Let's start with lesson number 1. First lesson, I think, is that people really want YouTubers to make big, bold predictions. And I think they want that so that they can disagree with them and, if necessary, ridicule them. That certainly happened a lot this year. It's kind of like that episode of SpongeBob where Mr. Krabs decides to host a summer camp for kids and promises them a clown but never delivers. And so SpongeBob has to entertain them. And he does so basically by bonking himself on the head, getting injured, squirting caustic chemicals into his eyes and things like that, which the kids love. It's very much the same on YouTube, I think. People want to see things that they can disagree with so they can feel better about it. Nevertheless, when I turned earlier this year, kind of midway through the year, towards trying to address more substantive issues. The viewership fell a little bit, but that's okay because I found that a lot of people engaged very deeply with the issues that I was raising, and things got more serious and the discussion actually became much more beneficial, and I do appreciate that. Second lesson I learned this year is that past performance is no guarantee of future returns, something we say a lot in my business. Fundamentally, based on history, I expected a much rockier year in the stock market. And as many people have reminded me, I called for a double bottom earlier in the year, which didn't happen, at least not in the stock market. Now, my reason for calling for that was because I expected that the initial rebound in stocks was overblown relative to the threat, and that there continued to be huge headwinds against the stock market across the board. But that led to lesson number 3. And that is that this year the stock market's performance has really been driven by 2 factors that are historically unprecedented. One is that thanks to extremely low interest rates, which were already in place before we came into the pandemic, stocks were really the only alternative for investors pretty much across the board. The second thing was that the Fed's commitment to continue that low interest rate policy indefinitely, plus the massive liquidity injected into personal markets thanks to stimulus checks, going a lot of times to people who didn't need them, like me, for example, led people to invest money in the stock market. Those 2 things, I think, conspired to chase up prices across the board. But interestingly enough, as I'll show you, it wasn't very much, the across the board part anyway. That is an entree to lesson number 4, and that is that the stock market, the broad stock market represented by the S&P 500, is only up about 14% so far this year. It is today, December 22nd, so I don't think we're going to get much more than that. Now, that's not very good compared to last year or even the year before that. So this year was definitely not a great year for the stock market in historical terms, at least compared to the last decade. And that shows, I think, that this was not a fundamentally driven year in the stock market. This was not driven by fundamentals of the economy or even of individual companies. It's based on speculation, largely, and that speculation was fueled, again, by the absence of alternatives and also by the presence of a significant amount of money in the economy that was available for retail investors to invest. I paid a lot of attention this year to volumes, to who was investing, institutional investors versus retail. And clearly, one of the big patterns this year was that institutional investors stayed on the sidelines for a significant amount of the year and let retail investors drive up prices. They were tempted back in this last quarter, but they have been pretty circumspect about it, and they've been pretty targeted in their investments. So generally speaking, I think this was a year more or less of gambling, which is what I called it. And as you know, with gambling, it's the same with speculative returns. They are rarely permanent. All it takes is an external shock to the system and things can change. Lesson number 5 is that a lot of people think that short sleeve cotton patterned shirts from India are pajamas. but they are not always. The ones that I've worn a couple of times, I have a black one and a blue one. One has little, palm trees on it, and one has something else. They're not actually pajamas. But what's interesting is that the word pajama actually comes from the Hindustani word pajama, which means leg garment, as you can see in this picture of a little girl from Hindustan from the 19th century. She's wearing pajamas on the bottom and a kurti on the top. So folks, if you do see me in one of those shirts, it's not pajamas. It's something I picked up in Mumbai years ago. Lesson number 6 was that a lot of people assume that this year was driven, the big gains this year were primarily around technology stocks. And that's true of certain individual companies. But the big gainers were actually not technology stocks in the sense of digital firms or online retail or companies providing remote connectivity like Zoom. Of the top sectoral gainers this year, 3 of them, at least from the ETF perspective, using that as a proxy for sectors, were in renewable energy. Here's the chart that shows it. TAN, PBW, and ICLN, all in the top 6 gainers this year. TAN, number 1. Now, what that tells me is that many investors, although they were chasing individual stocks that seemed like they were going to have a good year, and often did in the case of companies like Zoom and so on, that a lot of investors weren't looking at the pandemic and looking at stocks in that short-term perspective, but they were looking to the future. Now, one of the reasons why people, I think, put money into these stocks is because energy stocks were beaten down terribly this year because of the decline in demand for fossil fuels, consequent on the shutting down of economies, the slowing down of transportation systems, and so on. But I think it's also a reflection of the fact that this technology is the one that is maturing. It's renewable energy, and particularly solar energy, is maturing to the point where I think it is now rapidly becoming the main future source of at least electricity energy for many economies around the world. And that's going to be a big, big factor in the next decade. So to me, this was the year of renewable energy, something that I didn't see coming. I don't think anybody else saw it coming. And although I made calls, particularly my call on housing earlier this year, which was related to conditions specific to the pandemic, this one kind of came out of nowhere. And I think it's an important lesson to be learned that if you go looking for investments based on the short-term considerations of what's happening right in front of your nose, sometimes you can miss what's happening in the long term. Now, at the Bauman Letter, and certainly in my Profit Switch service, we haven't missed it at all. In fact, some of the biggest gainers we've had have been in the renewable energy sector. We have a couple of positions that have been in my portfolio for less than 2 or 3 months that have gained more than 50% already. And that's just a reflection of how powerful this move towards renewable energy has been this year. And that brings me to my final lesson for the year. And I think it kind of encapsulates the basis for a lot of what people understand to be my bearishness. I'm not really a bear. I'm basically what I am as a realist. I'm somebody who looks at the big picture. The problem is, and what I learned this year, is a lot of investors do not look at the big picture, and so they miss accumulating structural dangers. Whether that's because they prefer not to pay attention to them because they have a short-term orientation and think they can get out of the market before problems occur, or whether they just don't know about them is anybody's guess. But I found that as the year went by, increasingly many people commenting on my videos did begin to point out and say, hey, I think you're right about this. I think there are storm clouds on the horizon, and I like what you have to say about them. Now, the most important structural problem is the state of global debt markets. The emergency interventions earlier this year were based on a desire to reinforce liquidity. The most important short-term thing was to make sure that short-term debt in corporate markets could be rolled over. People often forget that government debt is really almost a non-entity when it comes to structural issues. A lot of people worry about it, but they should be far, far more worried about the amount of debt accumulating in corporations. Individual consumers tended to deleverage this year, but U.S. corporations and European corporations absolutely gorged on debt. They issued trillions and trillions of dollars worth of new debt this year to take advantage of low interest rates. Now, the problem with that is that eventually the world central banks and governments will not be able to continue to provide liquidity into these markets. And for companies that are not able to recover the cash flows and the revenues that they were experiencing prior to the pandemic, they will soon face solvency issues. And solvency issues cannot be faced by or solved by liquidity if debt markets have concluded that the companies really have no future prospects of being able to repay them. Now, one of the big factors, one of the most important things that happened this year, in my opinion, was the insistence on the part of Republican senators who are quite beholden to Wall Street, like Senator Toomey from Pennsylvania, who has taken millions of dollars in campaign donations from Wall Street financiers, intervene to ensure that the Fed is now forbidden from providing precisely the kind of liquidity backstop to corporate debt markets in the United States that we have relied on all year, without many people realizing that that's the case. So the lesson for me is that we are starting next year with pressures rapidly building in corporate debt markets. We're now in a race between the coronavirus vaccine and the balance sheets and cash flow statements of many of America's consumer-facing real-world companies. Now that the Fed's hands are tied, thanks to the Senate, we can expect either that we'll get there under the wire, that the economy will recover and these companies will begin to see money flowing into their coffers so they can repay their debts, or we'll start to see bankruptcies and business failures, which could have a significant ripple effect across the economy, and which could be precisely the kind of external factor that could lead to a lot of the speculative gains that we've seen retreating sometimes very rapidly. Now, I don't want to end on such a negative note. I just want to point out that one of the lessons this year is that when markets cease to be driven by considerations of supply and demand and value and pricing, etc., when they are rigged by artificial interventions, by federal or by reserve banks and central banks, and also by government policy, then they can just as easily be undone by changes in policy. And I think it's important to recognize that all of us this year who have benefited in the stock market have done so thanks to government intervention. And it's, I think, useful to ponder as we end this year that so many of us are opposed to government intervention in other parts of the economy. They're opposed to it, for example, when it comes to individuals' unemployment and things like that. But we're perfectly happy to benefit from it when it comes to massive intervention into financial markets. I think it's a good time of the year to sit back and ponder what that means, not just for how we feel about the way that government, which is supposed to be the expression of our collective will, the way that it operates differentially in different parts of the economy, the way that it treats different groups of interest differently in different ways, and also what could happen in the future if that were to change. That, for me, is the most important thing to consider going into 2021, and I'll leave you with that. So, have happy holidays, Merry Christmas, Happy Hanukkah, Happy Kwanzaa, and please enjoy New Year, but do it safely. We want to make it to the other side. This is Ted Bauman signing off. I'll see you in 2021.